Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Katy and I, Niels Kostrup Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Katy, it is so great to have you back this week. How are you doing? What's been going on where you are?
I'm good. Things are good. Fall is in full gear in Massachusetts, and we're doing well. Interesting times.
It's a nice time of the year. I don't mean what's going on in the world. I just mean that it's actually a nice time of the year where it's not too hot, it's not too cold, and there's a little bit of color on the trees. We're going to try and put some color on the financial markets today, but as we always do before we dive into all the fun stuff, I'm always curious to hear what's been kind of on your radar outside the topics we're going to be talking about in the last few weeks since we last spoke.
Well, I a fun thing that's been happening this past, recently is, I don't know if you saw, but the Nobel Prize went to 2 MIT professors plus 1 from Chicago. So I think there's just been a ton of buzz here and excitement. There's also been some prizes for chemistry and other interesting places related to MIT. So all of us are just like in the full Nobel coming kind of like excitement right now. Just innovation and, people doing exciting things that have contributed to society. So that's kind of been a hot topic this week at work.
Yeah, it's a great achievement. I know you and I talked about it before pressing record, but there was this article out a little while ago recently talking about kind of the concentration of Nobel Prize winners across universities, that there are definitely some universities that produces, if we can call it that, more Nobel Prize winners than others. But as you rightly pointed out to me, it doesn't mean necessarily people are from the same country. They can be students from abroad, I guess.
Yeah, what's interesting and what I've loved about being, connected to the MIT community is it's people from everywhere. And so, obviously MIT is one of those places. And what they have really fostered is this culture of bringing so many people together with so many different, it's just diversification, right? You have a higher Sharpe ratio when you have more diversification, people from everywhere. So I think they're also expanding and doing things more outside of just the US as well. So it's kind of about a culture of innovation and bringing different ideas together.
Yeah, no, absolutely. I still have very fun memories of my own guided tour by you on the MIT campus many years ago, I will admit. But I still remember it very clearly. And so fun and very interesting to see. And of course, very interesting that your offices, as far as I remember, are right across the street from MIT. Am I right in saying that?
Yeah, we were, but we actually moved downtown. We moved downtown. It's because MIT has become tech central. So actually our building got basically taken over by Google. And now it's all biotech and the technology companies that are very much in Cambridge. So we're actually downtown, closer to some of the other quant firms that are in Boston as well. So that has been a move for us a few years ago.
Okay. There we are. All right. Well, I was going to bring up my topic that's been on my radar this week, somewhat related to our industry, but in a completely different way. So, because I know you have, you know a lot about Scandinavia, there is actually, and maybe you know even this company, but there's actually a company in Denmark called Danske Commodities. It's a company that trades power and energy, but not just in futures like we do, but also moving stuff around physically and what have you. Anyways, the company had become somewhat more well-known in Denmark in the last couple of years because they had huge profits when energy prices and power prices exploded back in 2022. So not necessarily the kind of publicity you would want, but nevertheless, that's what happened. And this is a company that, according to a television program I saw, I mean, they trade not only commodities, which is similar to what we do, but they're also highly systematic. And in fact, they do on average like 30,000 trades per day. And on a busy day, like 100,000 trades. So it kind of sounds like high frequency could have been, a lot of these companies that we know from our industry. Now, here comes the interesting part. So this week, they announce that based on some research they've done, they have found that their traders actually should be treated like star athletes. So, in order to have these high-performing traders, what they are doing, they're installing like these cold plunges where you can take a cold bath after your performance. I guess after a hard work the day at work, they are providing breathing exercises like you would do with your athletes, and they're also going to give them an extra day of rest each month. Because the argument is, it's like a football player. If they played both Champions League and 2 games in their local league for the same week, you need a little bit of extra rest. So I thought that was quite interesting to kind of marry how star athletes perform better with certain things in their life. And now it's moved into our little world in terms of quote unquote star traders. Do you think this would be something for you, Katy, to have breathing exercises and cold plunges?
I do actually have a cold plunge because I'm a huge fan. And I have a Scandinavian husband. So sauna, cold plunge, I would suggest it to anybody. I think it's really good for your health. But I think this is fascinating, Niels, because I know many years ago also my PhD advisor from MIT also, they were studying sort of the physiological response of traders to the market. And it is true. Their point was that it's really a physical activity. So taking risk is a physical activity that we underestimate the physiological. And there were also a couple articles in Neurofinance where they showed a correlation between cortisol levels and the VIX. So to me, if you're an energy trader, you think the VIX is bad, try trading heavy energies. You got to be ready, So that does not surprise me at all. And maybe we need a cold plunge in the office, just.
Maybe trend following is a little bit less energy intensive.
It's a medium to long-term strategy. So maybe we don't need to do the cold plunge every day, but.
No, that's true. I think actually investors have had a little bit of a cold plunge over the summer looking at the performance, but we'll get to that in a few minutes. Now, jumping into something much, more usual for us, namely trend following. Now, of course, we are in October, kind of halfway through-ish, and we'll dig a little bit deeper in a few minutes into how you see things and what may lie ahead of us. But it is a continuation of what we saw as a difficult environment over the summer, no doubt. This month specifically, I would say we've seen some corrections in the currency sector showing up. Markets that, like British pounds and some of the commodity currencies, Aussie and Kiwi dollar for sure. Fixed income, of course, markets that have continued their somewhat correction that started a couple of months ago also. But then also a few bright spots actually in the grains area, gold, US equities, of course. The unstoppable US equity markets. So, performance-wise, still not a great month as of a couple of days ago, since we are recording a day early this week on Thursday. So this would be numbers as of Tuesday night. We do have the BTOP 50 index down 1.5% for the month, still up 2.6% for the year. SocGen CTA index is down 2.14% for the month, and it's kind of flat, up 0.25% roughly for the year. The SocGen trend index, it is down 3.25%, and it is down now for the year about 1%. And the short-term traders index down 67 basis points this month and down 14 basis points for the year. Comparing that, of course, to the traditional markets, the MSCI World up 33 basis points in October, up 17 0.86% for the year. The S&P Global Development Sovereign Bond Index down 47 basis points and up almost 2% for the year. And the S&P 500, as I mentioned, on a tear, up another 1.39% this month, up 22.5% so far this year. We'll come to themes and other things that I'll comment on that's going on, but I want to kind of dive in with you on this topic. Now, so far, it's kind of been a year where it's given us everything you could expect from trend following. We've had joy and excitement in the beginning of the year with a super strong Q1, then the challenges, the reversals, the pain during Q2 and Q3, culminating in kind of a difficult start for Q4, just as we head into one of the biggest events, not even for the year, but maybe for more than a year, which of course is the US election. We've seen meaningful dispersion of returns between managers. So I'd love to hear your thoughts on all of these points. And by the way, we've also seen some pretty large tracking error, is how I describe it, between CTA Replicator and the indices that they're trying to benchmark against. So enough to talk about, I think. So jump in here.
Wow,
Katy.
that's a lot.
What's been going on?
No, it's been, it's been I've gotten a lot of interesting questions about this year. And when I step back and look at this year, what I see is the best. You always have to think from a trend follower's perspective, what were the trends and what markets were sort of driven by volatility and uncertainty, where there wasn't really a sort of a key macro theme that was very persistent. I mean, that's just a simple concept. And if you look at P&L for CTAs, it has been predominantly positive for equities. Commodities has been mixed and positive in certain pockets, but really the thorn in the side has been currencies and fixed income. And if you look at that sort of from 50,000 foot, what you're seeing is, we're in a world this year where we're trying to navigate a pivot in monetary policy. And the markets have been focused specifically on expectations for monetary policy for fixed income and in currencies. And so at the beginning of the year, everyone was saying, like, here we go, we're going to have cuts. They didn't come. And then over the summer, there started to be some economic concerns, some data coming out that was a little more concerning. So we saw a pivot from a focus on inflation for monetary policy to economic slowdown and potential for demand destruction. And as you saw that, trends did a rotation into a more defensive posture. So we saw commodities, start to go down. And then as we moved into the fall and we started to see, for example, the Fed finally come into the game, then this month what we found is that people were too far ahead of themselves and expecting that Fed policy would be aggressive. And then you had that sort of re-evaluation of Fed expectations that happened earlier this month. So if you think about that holistically, the big picture is equities are still okay. And that's been a good trend, at least for now. And then, the fact that monetary policy has been such a key driver for fixed income and currencies has caused a lot of volatility in trend signals, because there hasn't been, like there was in 2022, a very strong, clear direction. And you've seen monetary policy ebb and flow and people's expectations changing. So really, it's been very hard to trade those two asset classes this year, which is not at all surprising considering, once you look back at it from more sort of a policy perspective. Because really in the trend world, we like things to be extreme, disruptive, consistent. And it's been very much yes, no, maybe, mixed data, et cetera, on those two asset classes.
Yeah, no, I think that's actually that's a great summary, and I completely agree with you in that characterization. I'm thinking back whether it's normal for us as trend followers to kind of be impacted so much by changes in sentiment, if I can call it that, rather than actual changes in policy, because it's not like we were surprised that rates would go down at some point, but the timing certainly has played a role. without dating ourselves, Katy, are there any years in the past where you can think that it's been a little bit the kind of the same types of sentiment drivers, not so much, the sector price changes, but just what caused them to get, as you said, excited about it and then less excited and so on and so forth? Or is this normal when central bank policies kind of transition from one regime to another? Is it just that, really?
I think it really is. I mean, because whenever you're going through sort of a transition, it's a question of stabilization of the trends that we measure. And if you look at what has happened this year, is that, whenever you ask anybody what's going to happen, everyone goes back and forth. I mean, this is what I'm noticing in sentiment. You go from the first half of September being like, everything's terrible, to the second half of September being like, nope, it's fine, everything's good, to, and that's been kind of the theme over the past few months, that the market is just grasping for something to know, where are we going? And I also think, and this may be a more philosophical question, is that, if we don't think about behavioral bias, then we're kind of missing the point, because especially trend followers are very behavioral focused. And the truth is we've moved from a regime of low interest rates to higher interest rates. And, we have a large number of people that are still holding on to this idea that, we're going to go back to normal. We're going to go back there. And I think that hope kind of magnifies the sentiment. And so I think only with time will we know, sort of what is the result of this change. I mean, my personal view is, and this is more just sort of a macro view, is that we've moved into a regime where inflation is much more important, and that we are probably not going to go back to the regime post-2008, this golden period of low interest rates, because that's a very, very strange environment historically. So, and, based on economics 101, it's very, it's a very strange environment. And so I think that at some point something had to give. And what we saw is that inflation had to come back. And so I think that people are still grappling with that. And then the next phase is going to be, how do we handle this new regime where cash rates are higher, and also where inflation volatility, so the potential for inflation is there. Not saying that we're going to go to 4% inflation. I don't think that. But I do think that we are in a world where sort of the baseline of rates may be higher. And that's something people are going to have to get adjusted to. And that's why this year has been kind of a strange year in that sense.
Yeah. And I would say, I like the way you've described that. I was listening to a podcast earlier this week, I think it was actually, with the chairman of the Chicago Fed, Austin Goolsbee, from memory, I think he was called. And I really kind of liked the way he was talking about some of these issues and challenges that they have, but also being very open to the fact that not a lot needs to go wrong in order for them to having to really rethink the plan. But at the moment, you could say the plan probably is that we have 12 or 18 months of a cutting cycle. It comes down to 3.5%. But as you rightly put, it's certainly much higher than what the low point was. Last time we had a rate cutting cycle. So it will be interesting. And somewhat related to the second paper we're going to be talking about today, in terms of trend following given certain interest rate regimes. So anyways, let's leave it at that for now, in terms of what's been going on in trend, and focus on something very important, namely your latest paper that came out. I'd like to say this week.
I think it came out for you, Niels. Like, I actually told him, I was like, all right, I'm talking to Niels. I got to tell Niels about my new paper. I'm so excited.
Okay, well, then people have something to look forward to for sure when it officially comes out. But we'll give a little bit of a... Okay, yeah. So we'll give a teaser and actually a bit of a deep dive. And of course, it's always best to get it from the source itself. And the new paper is called Trend Following in a Defensive Rotation, Reflections on Past Crisis Periods. First of all, what made you write this paper?
So this is a good question. And really what I saw happening this year. And I think what's super fun about being a trend follower is that you're really following where is the market going. And so you're getting this sense of how people are, what trajectory the market is moving in, and based on data, not based on your own predispositions. And so what was interesting for me is in the spring, you really saw this dichotomy between how equity markets were just super hopeful and happy, and fixed income markets were still short. So this higher for longer narrative. But then over the summer, there started to be a lot of noise in trend, and you started to see a much more defensive pivot in trend following positioning. So you saw positions go from being short fixed income to long fixed income. You saw energy positions and commodity positions that were generally long moving to short, particularly things like energies. And the dollar position, let's just not go there. It's been very hard. But either way, whenever you see that type of move, so you're kind of seeing more buying of bonds and sort of selling off of commodities, that's a relatively defensive position. It sort of shows some potential for economic weakness, potentially repricing of recession expectations. And so as we saw that pivot, to me, that's always interesting because it's the delta of where we were and where we're going. And so to me, I started getting a lot of questions from some of our clients like, okay, Katy, what does that mean? It's a defensive pivot. And so I said, I don't know yet, but what we can do as a trend follower is let's look at, given our positioning, it actually started to rhyme with the positioning we saw pre-COVID, which made me a little nervous because that's exactly what you saw at the beginning of 2020. As people got nervous about COVID, what did they do? They bought bonds to hedge their equity. They also sold out energy and sold out the commodity sector. We won't have to talk about how it went negative in energies, but either way. And so that is a defensive pivot. And it made me think, let's look at, just for fun, like if this is defensive and something happens, what kind of positioning works well if that happens? So we basically looked across different asset classes, ignoring equities altogether, except for equities being the conditional variable, and examining were we tending to be long or short in different crisis periods and drawdowns for equities in the different non-equity asset classes, and what worked and what didn't. And so I think that to me was an interesting thought question of, we're defensive right now. What happens if that defensive positioning is a sort of a precursor of a potential drawdown? So far, we haven't seen that drawdown yet, but what I did find, and this is very interesting, is that fixed income in every crisis period was a positive contributor for trend following. So that is kind of consistent with that trader commentary that the bond market is smarter than the equity market, in that people who have nerves, they go to the bond market, and the bond market is a good place to get that diversification. But I'm not talking just long, I'm saying long and short. So if you're long or short, and this is important now, especially now that we have a higher cash rate and potential for inflation, fixed income is a really good diversifier, but a dynamic trend following exposure to fixed income seems to work well in crisis. And then when you look across currencies, it is somewhat mixed, but being long the dollar has worked sometimes in certain events. And if you look across energies, it can also be a big contributor, but it really depends on the environment and what happens. Let's take COVID as an example. COVID, it was being short energy. In 2022, it was being long energy. So it kind of highlights the fact that, when there is, and I actually had a client ask me this question yesterday, when there is a disruptive event, it's about the ability to move to capture those trends, whichever direction they are, during a very, very different crisis period. So that was kind of what the paper demonstrated, is that the versatility of being able to move with prevailing trends in a moment of disruption or moment of change.
Which, of course, is part of your original definition of crisis alpha, because I remember we talked about that, and that is this, opportunistic and without bias and liquidity or in liquid markets kind of themes that we talked about. You've mentioned COVID a couple of times. I think that's still recent enough to people remembering that. And you're right. I mean, there are certain similarities when you look at the positioning right now. And maybe it's an unfair question because I'm sure you've looked at a lot of data, but are there any other periods that you can talk to in terms of, because this is the interesting thing in a sense, if you have a 60-40 portfolio, people will have relied on the negative correlation, and probably without knowing it, the fact that we were in an interest rate cycle that just kept going down as kind of their protectionist or the protection for their portfolio. With trend following, it's a little bit different, of course, and we don't know exactly how the markets will react, and therefore how we will react in terms of positioning. So I've never done that historical analysis. I'm curious as to what you found, maybe for some of the bigger asset classes, if there are some commonalities.
Yeah, I mean, I think what's interesting for me for fixed income, we have done some research over longer horizons, and that's why I was excited you sent me the Quantica paper as well that we'll talk about later. When you look at fixed income over longer time horizons, it's hard to look at trend falling over longer time horizons unless you stick to just trend falling signals in one asset class, because, obviously like the infrastructure, the futures markets, you have to make a lot of assumptions. But what was interesting to me, and that's why we wrote that other paper, Bonds Behaving Badly, is that as you look over longer horizons for fixed income, whenever you have higher inflation, you tend to have higher volatility for bonds, and you also tend to have more positive correlation between stocks and bonds. And what we demonstrated in this paper is that by having a dynamic long-short, being able to be long or short and following trends in those asset classes, you actually can get strong negative correlation from that dynamic strategy, which means that, I guess the takeaway for the common, the typical investor is bonds are great when rates are going down and we have very, stationary environment, but bonds are much more volatile and less predictable as a diversifier in an environment with higher rates and or inflation as a potential threat for bonds. And so for the typical 60-40 investor, that means, that 60-40 is still a good investment, but some of the correlation benefits and maybe even volatility properties change with bond dynamics. And thus, there's an opportunity for more long-short exposure that can improve some of the correlation properties of your portfolio based on just, finding something that could find that negative correlation. And whether it's long or short in positioning is going to depend on the environment. But definitely you can see that. I've seen that in data, much longer history, back into the 70s. It's harder to do it in the 60s, but, it gives you an idea. I'm not saying that we're reliving the 70s. We're definitely not. But there are some things to learn from history and from empirical analysis.
Yeah, I think maybe it was your co-author, Alex Grayserman. I think he once published a paper where they had done some analysis on which sectors in a portfolio does best during crises. And I think they found that actually one of the more consistent ones was commodities. Does that ring a bell?
I think so. Commodities.
From a trend following
before. I think commodities come in second. In our paper, we focused on energies.
Okay.
Specifically, just because, it's kind of and it's been so heterogeneous in the commodity sector, so it can vary quite a bit. And we focus on energy because it's kind of a core commodity that a lot of people think about as sort of a proxy for demand, and also some sort of indication of general themes of demand that could flow into sort of a shock against global growth or things like that. So I agree. I mean, commodities is a more diversified asset class, and it's probably fixed income and commodities that provide the most interesting trends in those environments. Currency is tricky. It depends.
Yeah. I mean, we've talked somewhat about this sort of the correlation difference that we sometimes experience, certainly between stocks and bonds. But of course, also within a trend following portfolio, correlation for most managers, not all managers, but for most managers, I think correlation does play a role. in terms of their risk management. Now, I know we will come to the next paper where we look at sort of trend following performance during high and low periods of interest rates. But just on the topic of correlation, have you any sense of how trend following portfolios might react differently or perform differently, maybe depending on whether correlations between stocks and bonds are positive or negative, and maybe in relationship to crises and so on and so forth?
So I haven't done that study explicitly, and it is actually harder to do, right? Because, there's been very few periods of time where stock bond correlation is positive. So it does become an empirically challenging task where our data set is going to kind of drive that. That's why I was so interested in a longer data set that included the 70s or the 60s. And I couldn't look at trend following explicitly as one particular strategy, but I could look at sort of how trend signals in bonds might behave so that I could understand that one asset class. But I do think, in an environment where there's positive correlation between stocks and bonds, you do have less diversification in those two assets, which, I haven't done the analysis, but could indicate that, there's a more polarized view with stocks and bonds. And as a result, being long both of those, you don't have as much diversification, but you also might generally when that happens, it's when inflation is higher or interest rates are higher. So those things are all connected, right? So the correlation has to come from somewhere. One of the things that I get a lot of questions about, what drives positive correlation between stocks and bonds? And my answer to that is that, a core driver can be inflation, and we've seen that. So if you think about bonds from the perspective of they are basically fixed on long-term cash flows. And so in a world where long-term cash flows are relatively stable and there's not a lot of disruption from inflation, devaluing and valuing cash flows, then bonds are sort of naturally just a risk-off asset, which is sort of a safe haven asset. But in a world where inflation expectations are non-negligible, there's always this sort of balance between the risk-off properties of those fixed cash flows and then the vulnerability of those cash flows to inflation shocks and other issues. So when you're holding a bond today, if you think inflation could be there is a actual threat to bonds with inflation. So they just behave very differently when inflation is a potential factor for bonds. And we saw that very clearly in the last 2 or so years. And it's been interesting, as inflation disappeared, what happened to stock bond correlations? They've gone back to normal.
Yeah. No, I mean, exactly. It's changing
so
again.
So now we've seen the classic risk-off behavior. And that's what I saw this summer. Starting in the summer, we started to see the markets play back the old rule book. Like, stocks are down, bonds are up. But we went through 2 years where stocks are down, bonds were down. And, to me, the only thing that's very different between those two periods is inflation went from very high to closer to 2.5. And so that sort of shows that without inflation, bonds are sort of more of a pure safe haven trade because they're fixed cash flows, they're safety. But if you take away the safety by adding inflation and devaluing those and adding volatility, the asset class becomes much more unclear.
Yeah, I'm curious about how it plays out from here, actually, in the sense that, because I actually don't think necessarily we're going to see it also just go back to this negative correlation that we saw for these decades, or for the first couple of decades of this century. But we'll see. I want to also, while we're in this part of the discussion, I also want to ask you, I know it's not part of the paper, but I do want to ask you a little bit about what you see in terms of, and whether you get questions about this, the dispersion between managers this year. It's also quite large, I would say, noticeable. Have you any thoughts on this, or what's the answer you give to people when they ask you?
Well, I usually start with, it's best to start with simple explanations first. And,
Sure.
When you think about trend following, usually it has to do with the environment. But the first thing I usually look to, there are two key factors. One is asset classes, and the second is speed. And so when you look across the space, let's start with speed. Slower I think has tended to be a little bit better this year because there were a lot of undulations. And you can see that just by looking at sort of if you compare ETF performance with some of the managers that are a little bit more complex and actually looking for crisis alpha and having faster signals. When you look at ETF performance, what is ETF performance tends to be more sort of medium to long-term trend. And so if you're medium to long-term trend, you probably did not jump on the bandwagon as much in some of these undulations, which helped you to kind of hold through some of the themes this year. So I think that's one factor. I haven't studied the factor explicitly, but that seems to, in certain pivot points, have been a big difference. Another thing is just sort of asset class allocation is the second I go to, because, just like any investment strategy, it's where do you have your risk? And if you have your risk in the right places, that makes a difference versus other managers. So basic trend signals suggest that equities and commodities were the two areas where there were key themes, whereas fixed income and currencies were challenging. So it's a combination of speeds. It's also a combination of how much risk you had in those asset classes and the timing of these moves. So those are two. The final one I would say is non-trend and macro signals, and the reliance on things outside of trend could matter as well. Let's say carry, for example. Carry had some pretty messy stuff going on in August, and you saw what happened with the yen. So that's going to be the third dimension. So first, time horizons, and where the frequency that you're trading really mattered through some of these undulations. Secondly, where was your risk by asset class? And third, how much other non-trend signals did you have that were exposed to some of these rather violent moves? For example, the carry trade in August, and other themes that were sort of more relative value this year could really matter, comparing from, say, pure trend managers and non-pure trend managers. And even a small allocation, if carry has a difficult and you're doing relative value carry, it can, have a big delta. And carry had been working very well most of the year. So that adds a lot of noise to relative performance.
Just out of curiosity, when you look at our industry, and let's just say we look at either the SocGen Trend Index or the SocGen CTA Index, just to keep it simple, how pronounced do you think it is today? And I know that's an impossible question to really answer with any certainty, but still, we give our best guesses here. How pronounced do you think it is to have, say, carry in these programs?
I love when you ask questions that I have a paper on. No, just kidding. A couple of years ago, I wrote an interesting paper, which was a factor analysis of CTAs in the SG trend, where we decomposed returns based on time horizons and other risk premia exposures. We had a few interesting summaries of this. I haven't updated the paper since then. I think it was 2018, so it's kind of old. But what we did see is that if you look early on, the reason this matters to me is people look at the SG Trend Index and think that it's, an index that you invest in, but it's actually a living, breathing, changing set of managers depending on the year. And the themes and markets. And so if you look at CTAs back in the early days, around 2000, they were much faster and much more pure trend. And then what we documented was the increase of influence of non-trend strategies within the index across different factors like value, carry, across different asset classes, cross-sectional momentum exposure and things like that, and how that had changed throughout the years. And we showed that most trend exposure had slowed down, so had moved to slower frequencies, but also that the influence of non-trend risk premia was relevant. And this was particularly true post-2008, when you kind of saw trend being a very tricky strategy. It'd be interesting to do that study now, because trend has actually been, back in vogue. I think, given this year and last year were a little trickier, but you definitely have seen the macro shifts have been made sort of pure momentum a lot more desirable in a higher interest rate environment. So you might see actually a shift the other direction. So I should redo the paper.
I think you should actually, and then you should come and talk to me about it, because also in a sense, because there was so much focus in August on quote unquote the unwind of carry, even though it lasted relatively short period of time, the damage wasn't, too bad or anything, but still it's a point of reference. It's some evidence that might show up in your research. And so that's why I think it is actually quite relevant to talk about and to analyze. So yeah, well, there is your homework for
great.
next time.
That was a big paper, by the way, too. So it was like a factor analysis of multiple strategies, and it was quite an ordeal. But I do agree, it'd be cool to do it again.
Sure. Before we leave your current new paper, what else would you like to highlight from it?
I think for me, what was interesting in this particular exercise is, and I've told you this already. Earlier, we were talking about this year. There's been so much. I go through 2 weeks where I'm thinking, oh, here we are. And then things look challenging and I'm wondering what the next big moves in the markets are. And then 2 weeks later, I'm going, well, it looks okay. So maybe I'm just correlated to the sentiment of the market as well. But, I think what I appreciated writing this paper and what some of our clients were interested in is just more like to understand that it's not about really what trend they think is going to work, that they need managed futures as something that reacts to those trends. Because timing these things, it's a fool's game, right? So, when is something difficult going to happen? It seems to happen. And then after the fact, we might think we knew it was going to happen. But usually these type of big changes, they occur and it takes us a while to actually realize that that's what's happening. And so I think this paper helped me to kind of remember that as well and sort of clarify that, there could be an extremely different trend this time around that could be the next sort of shock that we navigate. But we tend to do better in those divergent environments versus a convergent environment where things are kind of consolidating. And if you really think about it, 2022 was very divergent. And since then, we've kind of been sifting through the sort of the wreckage of what happened in COVID in 2022. And so the next question is where are we going next? And so I think that's what, kind of as a trend follower, you're trying to think about is what's the next big macro regime and when's that going to start? And we never know, but our positions are going to be trying to indicate where the markets are going.
Yeah, no, for sure. And I think that, even if you were a trend following skeptic, then I think at least you would probably acknowledge that looking around the world today, it doesn't look very convergent compared to 5 years ago. Yeah, it's going to be messy, it's going to be volatile, but I have a strong belief in at least the ability for trend followers to navigate and adapt and hopefully profit from whatever is to come, because I think it's going to be so different to what we may expect. Now, just before I forget, but I know you're going traveling, so you'll have some spare time, I'm sure, in an airport or wherever you may be. I will just tease up a little bit of an episode that we're bringing out on Wednesday, because Moritz had a fascinating conversation actually with the quote-unquote co-founder, or I don't know if he was a founder, but Bill Eckhardt, who obviously with Richard Dennis had the turtle experiment and had actually never been on a podcast before. So this is perhaps the first time ever to hear his side of the story. And I've listened to a little bit of it as I go through it just to approve it. And it's a fascinating conversation. So well done for putting that together, and hopefully people will enjoy that on Wednesday when it comes out. All right. Before we dive into the Quantica paper, you had mentioned, well, maybe we already talked about it in terms of what are some of the biggest things we're thinking about right now for trend and what we should expect. Anything you want to add to that? Or
this is I think we've kind of talked about it a little bit, but I think the things that we are thinking about, and as a trend follower, I'm always thinking about what are the things that investors are underestimating, particularly what are they being overly hopeful about that may be a little unlikely, or, so for example, concept of things like soft landing. It sounds fantastic. But I think for us, the bigger risk on the medium to long term are more an uptick in inflation and sort of what does that mean? And we've already started to see that in some of the bond, not the bond positioning, but for commodities, they really took a fall starting this summer. And they've been kind of resurging recently, which kind of makes me think, okay, so you have an uptick in the CPI in the US a little bit, and then you have commodities starting to surge a little bit. You have China flirting with stimulus. You have port closures in the US and sort of weather effects and things like that. And I'm just starting to think, it's sort of like landing in turbulence. Like you're going to land, but you could easily have a little bit of turbulence. So I think for us, the biggest question going into next year is going to be what happens with inflation, and how does that, kind of affect markets. And the other thing I think that has become more clear recently is also, in a world where economic data is reasonable and inflation is still not really at bay, we might just be in higher for longer, rates or at higher cash rates for quite some time now. And sort of because it does really feel like a lot of people, and you mentioned the election, a lot of people have been in a wait and see kind of pattern this year. Let's wait and see what happens with the US election. Let's wait and see with monetary policy. So to me, at some point, I think people have to kind of decide what camp they're in, where they're going to move. But I think it's been very hard to make decisions because it feels like there's a lot of things that have to be resolved before we know sort of what the real state of the economy is and what the next direction is. So I think next year it's the things that, possibly a more of a pause in rates, and also potential for uptick in inflation that could drive trends going into next year.
Yeah, actually, I don't disagree with that at all. So it will be super interesting. And also, actually, whoever wins the election, things may not be that different, really. So a lot of the policies that Trump installed vis-a-vis China, they've continued under the current regime and probably will continue whoever wins and so on and so forth. So we will see how that goes. All right, well, let's jump into another paper. We like what Quantica is putting out in their quarterly insights, and the latest one that came out last week is interesting in many ways because I think you've written about the same topic. What they're looking at specifically is, how do these strategies perform differently, if so, in higher interest rate environments and lower interest rate environments? I think maybe, and I can't speak for them, but certainly one of the things I've come across in my conversations when interest rates went higher was this kind of conclusion, well, why do I need trend following? Because now I can just buy bonds at 5%. And I think this, it's a fair statement, but it also shows that maybe they don't fully understand the benefit of what we provide, because actually you get most of the 5% inside your trend following as well. But anyways, leave that as it be. Let's talk about some of your takeaways from the paper, and maybe you can then put it into context as to your own findings around the same topics.
Yeah, I really like this paper. I like it because they took it another level. Let me explain what I mean. Okay. Is that they designated between high and low cash rates. Then they also explain sort of the different statistical properties of asset classes during these two different regimes, showing in essence that the biggest thing that they highlight is the fact that, bond correlations change significantly between stocks and bonds when cash rates are higher. And this is, kind of goes back to our inflation story. They didn't focus on inflation, but they focused on the level of rates, which is somewhat correlated, but not the same thing. And so if you think about that from a portfolio perspective, having that higher correlation means that your traditional 60-40 portfolio has less diversification. I also really like how they showed that, during sort of trend following's performance during periods where you have high or low cash rates, they find that trend following is negatively correlated with bonds. During sort of, trend following and bonds are negatively correlated, whereas, during low cash rates, they're slightly positively correlated with bonds. And so that suggests sort of a different dynamics consistent with what we talked about before. I do also think it's interesting that they did show that trend following has a little bit more volatility in return during higher cash rate environments. And then also expected return range were higher. So that's kind of what we were just talking about, that there's a little more volatility in relative performance as well. Sort of return range was wider, as well as the volatility range during that period. So to me, what I appreciate with the paper is they kind of focus on how the dynamics of trend and these traditional asset classes change when cash rates are higher, but how if you're building a portfolio, that you need to think about those things in terms of what is the right allocation to get a typical 60-40 type exposure. And then what they showed is that using some simple assumptions that, as cash rates are higher, you're actually better off adding trend because of the negative correlation to your portfolio. And so they kind of demonstrate that when cash is higher, trend is a good alternative to fixed income, which is exactly what you were just saying, but done in an empirical way that, trend following gives you that return, but then also gives you the correlation benefits that bonds seem to lose. So bonds as a long-only investment seem to lose some of the diversification that, yes, you get a higher return, but you lose some of the diversification, which means that, adding trend is more beneficial when rates are higher. And so to me, this was an interesting study. I think one thing that I would love to be able to ask them is, the data starts in 1990. So, that data period is definitely one where cash rates are much, much lower versus other periods. So, and they're dealing with the same problem that I dealt with in the paper on bonds behaving badly, is that, when you try to ask yourself a question with even higher rates or longer periods of high rates or periods of inflation, is the story the same? And I think the positive thing is it's very consistent with their findings. I can't speak to trend following as a strategy as a whole, but I can speak to the impact of the fixed income asset class as a diversifier. And so I think stepping back, they kind of suggest that today, when allocators are thinking about adding to their portfolio, it may be that bonds, even with higher rates, because they have perhaps poor diversification properties, they need to look to alternatives and other strategies to enhance their 60-40. Whereas we went through a period where the 60-40 with negative correlation between stocks and bonds was performed very well.
Yeah, I think actually, so in their conclusion, just maybe to put some numbers on it. So I think what they conclude is that in low cash environments, a 55-35-10, with 10 being trend, would be more optimal than 60-40. And in higher cash rate environments, it's actually 55-25 and 20 to trend. So a larger allocation to trend, to put some numbers on it. Do you think, you and I, and probably many of the people who listen to this, we can kind of very easily agree with these findings. Do you see any evidence among investors that they agree with these types of findings?
I do. And I think that's why I appreciate this paper, because why I pointed out that I like that they actually go through the allocation discussion is that we get a lot of questions. What's my size? And sort of part of the reason that I did write that paper about bonds behaving badly is sort of the first notion is bond yields are higher, so they're back in vogue. Well, yes and no is what I would say to them. And that's why I do actually positively see a lot of investors, though, asking themselves these questions and considering, and we do see investors that are allocating to managed futures and thinking about it, particularly in the US when I'm speaking to some of the even RIAs who, have saying we've been using managed futures, but we actually, I think that's why you may have seen some flows this year, even though it's not been a great year, because people are thinking about diversification. They're thinking about alternatives. They're thinking about liquid alternatives. because they recognize that their sort of tried and true 60-40 isn't, necessarily well equipped like it was pre-COVID. And that 2022 kind of woke people up to that, just when the diversification was gone between bonds and stocks. It kind of helped people to realize this can happen again. And caused people to start thinking about, is it 10 or is it 20? Is it 5? Is it 10? So I do think that is something that helps investors. That's why I like the paper a lot, because it was very practical.
And maybe we can make our own little conclusion, Katy, and that is, if people don't have time to figure out if we're in a high or low interest rate environment, they should just simply pick 15 as the core allocation to trend, which in an odd way is not necessarily a bad number. Of course, people inside the industry would probably go for something much higher, but 15% is where it starts getting meaningful and being able to help out if there is a crisis. But the 2 and the 3% that we often hear about, that just neither here nor there in terms of what they can do to help investors as and when they need it. But no, I agree. It's another great paper. Of course, it could be found on Quantica's website, and it's their Q3 quarterly report. Anything else as we start to sort of wind down? I mean, we still have lots of ways to go before this year ends in terms of things that may happen. We've seen some changes. We've certainly seen, I don't know if you've seen that on your side. I've certainly seen that, or it seems to me that risk has generally come out of trend following portfolios because of the changes in correlation and exposure in the equity and bond relationship. For sure, of course, one can never predict, but it certainly seems like a much more low risk, quote unquote, entry point, where even in a drawdown, that doesn't necessarily predict anything. But do you feel that people are, when you talk to them, feeling, oh, well, trend has been disappointing, it gave up a lot of the performance in Q1, or are they saying to themselves, well, actually, we've made good money on traditional assets this year. Trend has just kind of given some profits back, so we think actually it's an interesting time to be looking at the space. Well, what's your sense from investors at the moment?
Well, I think investors that understand the strategy understand that, you don't need it until you do. And what I am seeing, and I think the interesting investors who, look at it sort of, you should think about actually allocating to trend when trend is in a drawdown, as opposed to getting into it when it's up quite a bit. We've written some papers about this as well. And Alex and I talked about this in our book on trend following as well, is that, over time, there are these huge changes in macro regimes, trend captures them, they then consolidate. And when you have sort of a period where and that's why I was writing about the rotation, is that when you have a period where consolidating trends, this is often sort of a period before new trends emerge. And so I think, if you think about it from that perspective, it's usually better to allocate to trend in a drawdown than it is to kind of trend following, or trend following squared is what I would call it. So I do think that there are investors out there that recognize that. And they're saying, equities have done really well. Who knows how that goes? Bond yields have been high. So, at some point, there will be change. And so, there will be other opportunities at some point. So I think, pointing out from a signal perspective, I was just looking at this this week, is that trend signals across different asset classes are pretty even. So there's nothing that's really sticking out at this point, which to me suggests that it's a point of inflection where we're going to see what the next big trend is. And maybe it's post-election, maybe it's, sort of the Fed meetings that, spur a change in direction, or a different global event that changes things. But right now, it's definitely wait and see, and consolidate until you see the next big theme.
Finally, I wanted to bring up one other thing we had written down, and that is there any other research that you think is relevant at the moment?
That's a good question. No, I mean, I think we've been talking a lot about fixed income. So I think, I was really glad that you sent me the Quantica paper, because I think this one's very apropos. And for us, it's really been more some of the research on fixed income, just because fixed income has changed quite a bit. But I'll definitely send something to you if I see something exciting.
Sure. No, absolutely. Well, I can't wait for your update on, now I'm putting the pressure on, of course, for the update on non-trend influence.
The paper was called CTA
portfolios.
Style Evolution. Is that not so cool?
Ooh, it's such a great title.
Yeah.
Good stuff, Katy. You're off to talk to some of our trend-following friends, I know. So that'll be good fun. I wish you safe travels, and look forward to having you back in a few weeks as we get close to Christmas. Maybe for the group conversation, I need to organize that so we can get everyone together and make our outrageous predictions. One of my predictions have already, just to gloat a little bit, but my outrageous prediction was that neither Biden nor Trump would be, on the ballot. Now, one of them is still there. You never know, of course, in this world. But I thought that was interesting. Do you remember what your outrageous prediction was?
I have to look it up.
Oh my God, we need to go and listen.
Now I'm like a macroeconomist. I don't ever check on my predictions.
Yes. Oh dear, yeah. Katy, thank you so much. Next week, I will be joined by Rob. And so that'll be a good time to challenge him with some questions, maybe on system design or something like that you feel relevant. info@toptradersunplugged.com is the usual email. So feel free to send it there. And if you, as much as I do, appreciate all the hard work that Katy puts into these conversations, go and find your podcast player of choice and leave a rating and review and show your appreciation. From Katy and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.